You're listening to Financial Illumination, a podcast brought to you by Lumin Wealth. Please be aware that anything discussed on this podcast should not be regarded as financial advice, and when investing, your capital is at risk. Hello and welcome back to the Financial Illumination podcast, a podcast that shines a light on all things financial. My name's James Corcoran, I'm your host, and I'm joined today by my good friend and colleague Ben Mitson. How are you doing, Ben?
Very well, thank you, James. Of all the financial advisors at Lumin, I'm glad you could ask me for some insight today.
Absolutely. Well, everyone else was struck down with a bug, so you would have to do, but that's fine. No, it's really good to talk to you. And what I just wanted to do today is just talk over a few sort of recent issues that we've covered off in our fantastic Lumin News publication, which goes out to all existing clients and to a few other people as well. Yeah, some really interesting topics flying around at the moment. I just thought it would be good to cover off on here. I think for me at the moment, what I'm really seeing is impacting most clients that I talk to, and also, personally, I'm seeing big changes, is really the current interest rates being so high. It's obviously having a significant impact, whether that's people coming up for the mortgage side or savers. Savers are now, for the first time in a generation really, have actually got a choice to make because, interest rates are actually pretty decent if you're a saver. So is that something you've seen in your travels?
Yeah, absolutely. I think it's a fantastic article in the Lumin News, and I think it's something that we have clients always come up to us and ask us about. And we're more than happy to discuss these articles with our clients. So I'd definitely encourage reading those. But in terms of this specific topic, yeah, of course, I think there's opportunity in cash. And I think this is where you have to start considering the difference between short-term and long-term investment. So, of course, over the short term, we can put your money in sort of high interest, easy access savings account where you could be receiving sort of 5.5%, which, historically you wouldn't even dream of seeing those sorts of rates. So it's a fantastic opportunity to put your cash there in the short term. However, we see some fantastic reports from the likes of Schroders that actually if investing over the long term is always going to beat cash, and the longer you leave it invested, the better it's going to outperform cash, I should say. So I think in terms of whether you are, young, I think it'd be probably a better opportunity to stay invested. Whereas if you're looking to sort of retire in the next 2 to 3 years, maybe there might be some opportunity in cash for the short term, sort of draw an income from a high interest cash account. So yeah, that's definitely something we've been seeing, and it's definitely worth talking about from a cash versus investments perspective.
Yeah, I think that's a really good point. I think that the key thing for me is that when people talk about risk, they often just think about investment risk, like it going up and down, and that's a really important risk to be aware of. But that's one risk, and at the moment, for the first time, in years, really, we are seeing now inflation risk because yes, you can get. I had a client come and talk to me the other day about the option of sort of a savings account that was going to give them 5%. Fantastic. If you can get 5% on savings, that's great. But let's just think about that a little bit more, because they're actually a higher rate taxpayer, right? So are they going to get 5%? No, they're not, because they're going to lose 40% of that in tax. So they're not getting 5%, they're getting 3%. So it's not all it's cracked up to be. And while inflation right now, I think the figures this morning are up at 6.7% at the moment. So in reality, yes, it looks great, 5%, but no, really, it's 3. And really, it's minus 3.7% because we're in this high inflation period. So it's really tough though, because I do understand it. If you've got that guarantee, and that's really important to you, and you love the fact that there's that guarantee, that's great. But I do have this thought that in a year or so's time, people that have tied up cash at net 3 or 4% may well be kicking themselves if the market has a really good run and they've just missed out.
In terms of the interest rates now, I think it's something you want to have a look at in terms of existing cash. There's opportunity there for existing cash. In terms of cash that's already invested, I don't think I would advise taking that money out of existing investments. As you said, the reason being, when we do see the markets turn, you're going to be late to the party. It's the age-old saying of it's time in the market, not timing the market. And as I said previously, I think over the long term, 5, 10, 15 years, which most investors are looking to keep their money invested for, you will always be cash in the long term. So it's having that long-term mentality. Don't make a short-term decision on this. I think in terms of alleviating people's worries and pressures about what they should do with their investments, I think it's just sit tight and weather the storm. The most you can do now in terms of these interest rates is just use them for your existing cash holdings. We often find it when we're speaking with clients that they still have most of their cash with their bank current accounts that are paying 0.3, 0.4. I think that's where clients need to be a bit more productive and seeing what's out there in terms of easy access savings accounts where they could put that current account money into something that's going to work a bit harder for them.
Yeah, no, absolutely. And that's something I think that we as financial advisors, just to clarify, when we're advising on cash, that's not really something we don't charge fees on it, for instance. But for me personally, it's always a really important part of the job. It's not necessarily the thing that's the number one priority. That's sort of really understanding, what people are trying to achieve over the long term, and are we, is the money in the right place to do that? But when you're looking at cash, absolutely. I remember for a few years, it's just been, is it really worth, shifting your money around because you're really going to struggle to get 1%, and is it even worth the bus fare to go into town to do it? But now it genuinely is. Now you can actually, if you've got 60 grand sitting there earning you 0.2, well, yeah, absolutely. There's some cracking rates out there.
Absolutely, I'd agree. I think where people are also slightly worried and concerned in terms of these high interest rates is often, we've seen fluctuation in investment performance recently. The reason being is for the first time in a long time, we've seen sort of a positive correlation in fixed interest and in equities. So what that means is within most people's portfolios, you have a blended portfolio of equities, fixed interest, some diversifiers, maybe things like property. And essentially, it's all geared towards working in a way that's correct with your attitude to risk. So typically, your equities are the more adventurous investment in which you can see a lot of market upturn, but also a lot of market downturn. But with your fixed interest, your bonds, these are sort of backed against sort of governments and companies, essentially loans from governments and companies, and you're expected to see a return of that investment. However, they perform particularly badly in times of high inflation. So we've had it where there's probably been not really a safe place for anyone to hide within their portfolio, regardless of their risk rating.
Sure.
So again, this is me saying to my clients, as I'm saying to you on the podcast, is that I think previous performance has been incredibly unusual. Our chief investment officer, Mike Felton, spent many years working in the city as a fund manager, and he said he'd never seen a year like it, the previous few years that we've had. I really think it's just weathered the storm, and things will pick up as we are seeing. So again, another reason to stay invested over the long term.
So I suppose that's all based on people that have got money in the markets and are potential beneficiaries of good interest rates. What about the other side? There's obviously people that have got mortgages, are borrowing money right now, and I'm very lucky. I signed to a 5-year fixed rate a couple of years ago. So for me, I'm all right, Jack, for at least for a couple of years.
Yeah.
But I know there's a lot of people, very concerned. Every month people's fixed rates are coming up, and if you fixed at 1 or 2%, suddenly we're now seeing sort of 5-6%. So I mean, is that something you've seen? Is there, people are concerned, and what can they do about it?
Yeah, of course. I think when talking about mortgages, there's obviously you have to deal with it on a case-by-case basis. But I don't necessarily think that all debt is bad debt. I don't think mortgage debt is particularly bad debt. And I think if it's a debt that you can service comfortably, it's not something you should be worried about. I think in terms of investment, we can look to put money into an ISA, into a general investment account, or even into your pension. And it's about the time period. And if you can keep that money invested over 5, 10, 15 years, the returns on that should be more than the interest rate that you're paying on your mortgage. So we can see these as looking to service a debt now, but in the future with sort of strong returns via investments. So this is a really great opportunity to speak with your financial advisor on these specific topics, or more importantly, we can speak with a mortgage advisor. So where Lumin have been seeing great successes is with the acquisition of Davidson Dean. So we have specialist mortgage advisors partnered with financial advice here at Lumin, and it essentially means we can give our clients a much more tailored package when it comes to addressing mortgage concerns and providing appropriate and tax efficient mortgage solutions.
Yeah, no, that was brilliant. I mean, one of the things for me coming here is that I am an ex-mortgage advisor myself, and I used to recommend different mortgage advisors, but it was always really hard to find a good mortgage advisor, because I tell you what, that is the most stressful job I've done. If you're a mortgage, think about it, how stressful it is dealing with your own mortgage. Imagine that's your job every day, dealing with everyone else's mortgages, and you're getting hassled by the solicitors, by the estate agents. Can you get me this rate? Or is it going to fall through? How much can I borrow? That is a hell of a job. And so I was really pleased when I came on board, and the guys here at Davidson Dean. And I think that's the difference is, once again, back a few years ago, you didn't really have to shop around as much. If your provider was going to offer you a 1.4% fixed rate, well, even if you shopped around, what you're going to get, 1.2 or 1, but it's going to be pretty negligible, the actual difference in your monthly payments to actually shift around. So hence a lot of people really just remained with their own lenders. Mm-hmm. Whereas I think for the first time in a long time now, actually, if your lender's going to put you onto a quite a pretty heavy standard variable rate or offer you a fixed rate, actually it is the right time to now be engaging a mortgage advisor to actually look for it, because those, the potential savings are really significant by making sure you've got that best deal in place.
Absolutely, I agree. And I think that's the ultimate conclusion I've found in working with my clients over the past year is really, whilst things on the outside can look a little bit turbulent, a little bit scary, it's actually a really great opportunity to speak with your advisor, because there's lots of work to do and lots of opportunity there.
Yeah, absolutely. Well, look, Ben, thank you so much for your time today.
Thanks a lot, James.
It's been fantastic. And if the clients want to get hold of you, then what's the best way to do that?
Yeah, so they can contact me on my Lumin email address, which is ben.mitson@luminwealth.co.uk, or you can contact the head office and they'll put you through to an advisor who's available.
Absolutely. And I am james.corcoran@luminwealth.co.uk, or you can hit us, both of us, up on LinkedIn. All right. Well, look, thank you everyone for listening. It's greatly appreciated, and we will be back in touch with the next episode very soon.